1 week on from Brexit, we're going to talk about 3 things. We're going to talk about markets, our portfolios, and we're going to talk about what's next. 1. Markets. Markets were volatile in the days following the Leave vote, but they weren't disorderly. Now, the FTSE 100, because of its international nature, has been quite well supported, and in fact, it's at its highest level since mid-August of last year. In fact, in a few years' time, when you go to plot the FTSE 100 chart, you'd be very hard-pressed to identify the referendum event. And that might even be true for the FTSE 250, which is the mid-cap, more domestically oriented index, which was harder hit. The thing in which you will see the referendum event is the sterling-dollar exchange rate, which on the day fell about 7.5%, which was the single biggest one-day decline in the sterling dollar in our market memory, certainly in mine. 2. Portfolios. Our portfolios were positioned for the central case of Remain running into the referendum. So obviously, some of our favored investment thematics were hurt, but this was mitigated by the non-UK portion of our portfolios where foreign currencies rallied against sterling. Now, we were prepared for a Brexit trade in the case that it did happen. We had an order in the market if markets were dislocated enough, but markets didn't fall as much as we expected. However, circumstances are evolving, and we are looking for opportunities to do so going forward. 3. What's next? There are lots of unanswered questions on the horizon, and we don't want to be too complacent about the recovery in equities over the last few days. Nevertheless, equities remain our favored asset class. We still think that equities are attractive, although we have moderated our view, having taken back some of the equity overweight positioning in the last couple of months. Monetary policy conditions are going to stay easy. The Bank of England governor told us this on Thursday afternoon. Lower rates for longer is going to persist. 2-year gilts are at 0 or even negative. This will push investors to embrace sustainable but riskier income streams. And by that I mean things like longer dated gilts, corporate bonds, corporate loans, even equities, commercial property.